Preparing for a private equity fund accounting interview. Capital calls, distributions, and carried interest waterfall? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through what happens from an LP commitment to a capital call and actual investment funding. The interviewer wants to assess whether you understand the life cycle from LP commitment to funding, including legal obligation, notice process, cash movement, unfunded commitment tracking, and how calls support deal execution. While answering, focus on commitments versus cash contributions, GP authority under the LPA, pro rata funding, due dates, reductions to unfunded commitment, and why timing matters for closing investments. An LP commitment is the maximum capital an investor agrees to provide, not cash paid on day one. When the GP identifies an investment or needs fees and expenses, it issues a capital call notice. The LP wires its pro rata share by the due date, reducing unfunded commitment and increasing contributed capital. The fund then uses that cash to close the deal or pay fund level costs. Question 2. How do you distinguish commitment, called capital, contributed capital, and unfunded commitment? This question evaluates your precision with fund accounting terminology and whether you can explain how commitments, called capital, contributed capital, and unfunded commitments appear in investor reporting and operations. Make sure to cover legal commitment, GP call request, actual cash receipt, remaining obligation, and the importance of using consistent definitions across capital account statements and internal reconciliations. I keep the terms separate because they drive reporting and economics. Commitment is the LP's legal obligation. Called capital is the amount requested by the GP. Contributed capital is cash actually received and recorded after the call settles. Unfunded commitment is the remaining obligation, total commitment minus cumulative called or contributed capital, depending on the report convention. That balance matters for liquidity planning and exposure monitoring. Question 3. What information would you expect to see in a properly prepared capital call notice? The interviewer is testing your understanding of operational controls around capital calls, including what information LPs need to validate the request, process payment, and reconcile their commitment exposure. In your answer, talk about investor identity, commitment percentage, call amount, purpose, due date, wire instructions, cumulative calls, unfunded balance, approval evidence, audit readiness, and operational accuracy. A proper capital call notice should let an LP verify, approve, and wire funds without ambiguity. I'd expect the fund name, LP legal name, commitment, call percentage, dollar amount, due date, bank instructions, purpose of the call, and allocation between investment, management fee, expenses, or reserves. I'd also check cumulative called capital and remaining unfunded commitment. In operations, clean notices reduce funding errors and investor disputes. Question 4. A $500 million fund calls $100 million for an investment, plus $5 million of fees and expenses. An LP committed $25 million. This question evaluates your ability to apply pro rata allocation mechanics, calculate an LP's funding obligation, and update unfunded commitment based on the fund's aggregate capital call. While answering, focus on calculating the LP commitment percentage, applying it to the total call, explaining whether expenses count against commitment, and updating the remaining unfunded amount. I'd calculate the LP's share based on commitment percentage. A $25 million commitment in a $500 million fund is 5%. If the fund calls $100 million for the investment, plus $5 million for fees and expenses, the total call is $105 million. The LP funds 5%, or $5.25 million. Its unfunded commitment falls from $25 million to $19.75 million. Question 5. What happens if an LP fails to fund a capital call on time? The interviewer wants to assess your knowledge of default provisions, administrator responsibilities, investor communications, and how the fund protects closing certainty when one investor misses a call. Be sure to mention the LPA, notice procedures, interest or penalties, suspension of rights, forced transfer or dilution, possible reallocation, and the need for consistent application. First, I'd check the LPA because remedies are contractual. Operationally, the administrator tracks the missed payment, sends default notices, and applies interest or penalties if allowed. Economically, the GP may suspend voting rights, force a sale of the defaulting LP's interest, dilute distributions, or reallocate the shortfall temporarily to non-defaulting LPs. The key is protecting the fund's closing obligation while applying the LPA consistently and transparently. Question 6. How do distributions work in a PE fund, and why do you separate return of capital from profit? This question evaluates whether you understand distribution sources, investor reporting, capital account classification, and how the distinction between capital return and profit feeds directly into waterfall calculations. In your answer, cover exits, dividends, refinancing proceeds, expenses and withholding, return of capital, realized gain, recallable amounts, and the link to preferred return and carry. Distributions are cash or securities returned to LPs after exits, dividends, refinancings, or excess cash releases. I'd separate return of capital from profit because it affects preferred return, carried interest, and investor reporting. The notice should show gross proceeds, expenses, withholding, recallable amounts, and net cash paid. In a waterfall, early distributions usually repay contributed capital first, then preferred return, then GP catch-up and carry. Question 7. What is a recallable distribution, and how does it affect an LP's remaining commitment? The interviewer is testing your understanding of recycling provisions, liquidity implications, and how distributions can increase future funding obligations rather than permanently reducing exposure. Make sure to cover recallable versus non-recallable distributions, restored unfunded commitment, LPA limits, examples involving realized proceeds or unused capital, and why LPs monitor this closely. A recallable distribution is cash paid back to LPs that can be called again later, so it restores part of the LP's unfunded obligation. For example, if an LP committed $10 million, funded $4 million, and receives a $1 million recallable distribution, its contributed capital may remain tracked, but available commitment increases from $6 million to $7 million. Interviewers care because recallability changes liquidity planning and commitment coverage. Question 8. Explain the difference between an American waterfall and a European waterfall. This question evaluates your understanding of carried interest timing, GP economics, LP protection, and why deal-by-deal waterfalls create different risk profiles from whole fund waterfalls. While answering, focus on deal-by-deal versus whole fund carry, return of capital sequencing, preferred return, escrow, clawback, GP liquidity, and which structure is more LP-friendly. The big distinction is deal-by-deal versus whole fund economics. In an American waterfall, the GP may receive carry after each successful exit, often with escrow and clawback protections. In a European waterfall, LPs generally recover all contributed capital and preferred return across the fund before carry is paid. European is more LP-friendly and slower for GP liquidity. American accelerates carry, but creates clawback risk if later deals underperform. Question 9. What is the preferred return, or hurdle rate, in a PE waterfall? The interviewer wants to assess whether you can explain the LP priority return, how it is calculated, and why it must usually be satisfied before carry is allocated. Be sure to mention priority economics, simple versus compounded calculation, whether it is cumulative, timing under the LPA, no guarantee of payment, and interaction with catch-up.
The preferred return is the priority return LPs receive before the GP earns carry.
If the hurdle is 8%, the waterfall asks whether LPs have recovered capital plus that compounded or simple preferred return, depending on the LPA. It is not necessarily a guaranteed return. It is an allocation threshold. Once satisfied, the waterfall may move to catch-up, where the GP receives most or all incremental profits temporarily. Question 10. How does a GP catch-up provision work after the preferred return is paid? This question evaluates whether you understand the mechanics that transition economics from LP priority return to the negotiated GP carry interest percentage. In your answer, talk about 100% versus partial catch-up, cumulative profit sharing, how the GP reaches the target carry percentage, and residual split mechanics. Catch-up is the mechanism that brings the GP to its agreed profit share after LPs receive their preferred return. Suppose profits are $100 after capital is returned. Carry is 20%, and the GP has received nothing while LPs got the pref. In a 100% catch-up, the next dollars go to the GP until it has 20% of cumulative profits. After that, remaining profits split 80-20. Question 11. Walk me through a European waterfall with $150 million of proceeds, $100 million of contributed capital, a $12 million pref, 20% carry, and 100% catch-up. The interviewer is testing your ability to calculate a waterfall live, sequence the tiers correctly, avoid double-counting profit, and explain the economic outcome clearly under pressure. While answering, show return of capital first, then preferred return, then GP catch-up, then residual 80-20 split, with clear totals to LPs and GP. Start with $150 million proceeds. Return $100 million contributed capital to LPs, leaving $50 million profit. Pay the $12 million preferred return to LPs, leaving $38 million. With a 100% catch-up and 20% carry, the GP gets $3 million. Because $3 million is 20% of the $15 million distributed after capital, before the residual split. The remaining $35 million splits 80-20, $28 million to LPs, and $7 million to GP. Question 12. How are management fees different from carried interest in fund economics and accounting? This question evaluates your ability to distinguish recurring fund expenses from performance allocations, including how each affects capital accounts, net returns, and investor reporting. Make sure to cover fee base, investment period changes, expense treatment, management fee offsets, carry as profit share, and dependency on waterfall hurdles being met. Management fees are recurring compensation for running the fund, usually based on committed capital during the investment period and invested capital afterward. They are expenses or offsets under the LPA, not performance allocations. Carried interest is the GP's share of profits after the waterfall hurdles. In modeling, I treat fees as reducing fund economics before distributions, while carry is allocated only after capital, pref, and catch-up tests are satisfied. Question 13. What is a clawback and why is it important in carried interest arrangements? The interviewer wants to assess your understanding of over-distribution risk, GP carry protection mechanisms, final true-up calculations, and why LPs negotiate clawbacks strongly. Be sure to mention American waterfalls, early profitable exits, later losses, aggregate carry limits, repayment obligations, tax considerations, escrow, guarantees, and interim true-ups. Clawback protects LPs when the GP receives too much carry before final fund performance is known. This is common in American waterfalls because early winners can pay carry while later losses reduce total profits. At liquidation, the administrator recomputes aggregate economics. If the GP received more than the agreed percentage, it must return the excess, often net of taxes. Escrow, guarantees, and interim true-ups reduce collection risk. Question 14. How does equalization work when a new investor joins the fund at a subsequent close? This question evaluates your understanding of subsequent close mechanics, fairness between early and late LPs, and how equalization payments adjust prior capital calls and economics. In your answer, cover funding prior calls, equalization interest, reallocations to existing LPs, updated commitment percentages, capital account adjustments, and the economic purpose of treating investors consistently. When a new LP enters at a later close, equalization puts it in the same economic position as if it had joined at the first close. The new LP funds its share of prior capital calls, plus an equalization interest amount if required. Existing LPs may receive part of that cash back or have future calls adjusted. The goal is fairness. Late investors should not get a free option on already funded investments. Question 15. What controls and reconciliations would you perform around capital calls, distributions, and waterfall allocations? The interviewer is testing your practical fund administration mindset, including reconciliation discipline, LPA compliance, payment controls, investor allocation accuracy, and audit-ready documentation around cash movements. While answering, focus on investor registers, commitment percentages, bank reconciliations, approval workflows, notices, deal proceeds, waterfall models, withholding, payment files, capital account roll forwards, and exception review. I'd reconcile from the LPA and investor register to the bank and accounting records. For capital calls, agree commitment percentages, call rates, cash receipts, and unfunded balances. For distributions, tie proceeds to deal realization, waterfall calculations, withholding, and payment files. I'd also review approvals, notice dates, wire instructions, and investor allocations. The best control is a full roll forward. Opening capital, calls, distributions, allocations, transfers, and ending capital. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.